So welcome back guys, this is Mayank, and in this last lecture of the security valuation chapter we are going to start with the concept of money market instrument. Now if you go to the chart and have a look on the money market heading, there are few things that we are going to discuss. The characteristics is something that you should read once before starting with the practical questions, and in fact I would strongly suggest you to go through the theory of money market instrument first before you start the practical questions, because you will understand there are few things in each of them which are very important, and obviously I am going to discuss them in the question, but I think it will be very easy for you to understand if you come to the practical question and this video after reading the theory. Trust me, this is going to benefit you a lot. Okay, so these are the instruments that we are going to discuss. We are going to see some questions on treasury bill, commercial paper, certificate of deposit, repo, reverse repo, and so on. Okay, each one of the instrument has a different feature, and in order to understand that you will have to read the theory. Okay, so I am assuming by now you have read the theory, and now we are going to start with the questions. Okay, before starting the question, let me just tell you that we will be starting with 3 to 4 questions of treasury bills. That's a very small concept, and before even taking those questions I would like to discuss a couple of things. Treasury bills and similar kind of instruments are normally issued by the bank. Okay, now what happens is suppose I'm not saying about the treasury bill, any kind of a money market instrument. There are certain instruments in the money market whose face value, let's say for example, is 100 rupees. Okay, and it is issued by the bank for, let's say, 91 days. Normally money market instruments are issued in the market for short period of time, so it is issued in the market for 91 days, and let's say for example it is issued at a discount of 10%. So what will be the issue price? Issue price will be 90 rupees. Do you agree with that? Okay, so what happens in this entire thing is there is no coupon rate. You pay 90 rupees as an investor, you will come to purchase this, you will pay 90 rupees, this will be your investment. Okay, just a second. This will be your investment, and you will get 100 rupees after 91 days. This will be your redemption. Your profit will be 10 rupees. Now I will talk about two things: rate of discount and rate of yield. And you can see the amount for both of them is same, 10 rupees. Let's say for example the discount was 10 rupees on which amount? It will be calculated on the face value. From the company's angle, they are issuing a bond in the market or a treasury bill or any kind of an instrument in the market at face value, but at a discount of 10%. So that 10 rupees discount was given on 100. So that's how discount is calculated, right? But as an investor, your return is 10 rupees and your investment was 90. You don't have to do anything with 100. 100 is something that you received at the maturity, but the investment, the amount of cash outflow that is going from your pocket matters the most to the investor. So whenever you will be calculating yield, you will be calculating it on your investment. So this is going to be the difference that you will see in the couple of questions, and your return will be 11.11%. So the rate of discount for company is not equal to the rate of yield for the investor. Why? Because for investor, yield is calculated on his investment, and for the company or the bank, discount is calculated on the face value, or we can say the redemption value. Understood? Okay, next thing. Whenever an investor calculates a rate, normally this is a practice which is being followed. You can follow it in the exam or not, but at some places you will find this thing, and what I can say is bank. Now Whenever an investor will calculate his yield, normally he will take 365 days in a year. But there is one standard practice which is followed by most of the banks. Many times for banks, whenever they will calculate discount or something or cost, we can say, they will take 360 days in a year. So at some places this might happen that the banks are using 360 days instead of 365 days. Now for the purpose of SFM and exam and CA and for the marks, you can use 365 days or you can use 360 days, whichever suits you, if there is nothing given in the question. Understand, the last thing is very important. If it is not specifically given in the question, then you can use 365 days or 360 days. More specifically, if you are calculating something from the angle of the investor, use 365 days, and from the bank's angle, use 360 days. Okay, so there was something that I wanted to tell you before taking the question. There are few more things that we need to learn. We need to learn over a period in order to solve the question. Let's have a look on question number 10111. So 111 question number, have a look. RBI sold a 91-day treasury bill of a face value of 100. Understand, if they are selling a treasury bill for 91 days, it means that 100 rupees will be given back to the investor after the end of the 91 days at an yield of 6%. That means whosoever will be buying this bond or the treasury bill, he will earn a return of 6%. A return of 6%. But that 6% is always quoted as per annum. Normally the rate of return given in the question is always quoted as per annum unless otherwise specified. So that 6% is entirely for the year. So what has been asked to us is issue price, to calculate the issue price, and you can do it by using simple compound amount formula. You don't want to learn all these things, it's okay, but you can use the compound amount formula or simple interest formula as well in order to calculate this. See, let's say the price is X at this point. Okay, now what is going to happen? I will just write down compound. We are not going to do the compounding. Compound amount is equal to principal in bracket 1 plus R. If we take it as per annum, okay, let it be. We'll just calculate it for 91 days and then we'll convert it. Okay, now R in this question is 6%. If you want to calculate it for 91 days, what you are going to do? You are going to divide it by 365 days and multiply it with 91 days. You will get an R for 91 days. Simple. That will go to 1.4959%. Okay, now what will happen? You are getting 100 rupees at the end. This is going to be the issue price. That percentage is 0.01. How much is the return? 0.014959. Let's solve it. 100 divided by 1.00014959. The answer is 99.85. Okay, so let's have a look on this question. RBI sold a 91-day treasury bill. So 91 days is the maturities. Treasury bill of a face value of 100. So if they are selling a treasury bill, that 100 rupees will be paid back to the investor after 91 days, which will at an yield of 6%. Say, yield means the return which is always calculated on the investment. In this case, it will be issue price. Now the question is asking you at how much price the company or the RBI has issued this bond. You have to calculate a price in such a manner that the person who is investing in this treasury bill should earn 6% per annum. That 6% is per annum. Okay, obviously 91 days is the total maturity period. What we are going to do is we are going to convert that 6% into 91 days rate, and then we will find out. How to calculate yield? It's very simple, sir. Yield is nothing but return on the numerator divided by investment in the denominator. That's what we learned. But if we keep 6% here, we will have to convert that return into per annum return, because if the rate is, let's say here, if the rate that you are taking on the left hand side is per annum, the right hand side should also be per annum. So what we are going to do, we are going to convert it into per annum basis. This return that you are taking up in the numerator, can I say that this return is only for 91 days? So if this entire return is for 91 days, what will be the return for 365 days, right? So let's do it. 100 rupees is the price that you will receive back, and the investment was X, issue price, on X amount. Numerator can be easily understood as the return divided by the investment. So 365 divided by 91, you can solve this question, you will get the X as 98.53. So if you issue the treasury bill at 98.53 and redeem after 91 days at 100 rupees, we can say that the person who is investing in this treasury bill is earning 6% on per annum basis. Question number 112. Again, this is a question of treasury bill, and issue price is already given to you, at which the Mr. X has purchased this treasury bill. Okay, maturing in 91 days, same for 10,000. This is the face value. Now we can easily calculate the difference between two is the return. The difference between two is the return to the investor and discount to the bank. Okay, how much? 10,000 minus 9940. So understand, at 60 rupees is something. 60 rupees is something which will be a return to the investor and a discount for the bank. So this is return and this is discount. And you know very well, we just had a discussion about it. Return is always calculated on the investment and discount is calculated on the face value. And if it is given for 60 days or 91 days, it's your responsibility to convert it into per annum basis. Okay, then what would be annualized investment rate, or you can call it as yield, and annualized discount rate? They have clearly specified as we have to calculate it annualized. 60 is the return and discount for 91 days. You should convert it into annual. Okay, this entire thing, 60 divided by 9940 investment, 60 divided by 10,000, you can clearly see discount. Now it is very clear to you why we are using a different denominator in both the cases, because discount is given on 10,000 and investment return is calculated on the investment, that is 9940. So return goes like this and discount goes like this. Okay, then this entire 60 rupees was for 91 days. We converted it into per annum basis. Now you can clearly see that at the time of calculating the discount, bank has taken 360 days, while an investor, a normal investor like you and me, is taking 365 days in the numerator. So it's all up to you. My suggestion is to go with this only. And once you calculate it, this is going to be the yield for the investor. This is going to be the discount for the bank on per annum basis. So it is very clear, discount rate and investment rates will not match 2.42% and 2.374%. Why? Because the denominator used in the beginning is different. Okay. Question number 113. Suppose government pays 5,000 rupees at maturity for 91 days. At maturity. So this is the face value or the redemption value. For 91 days treasury bill, if Mr. Y, the investor, is desirous to earn an annualized discount rate of 3.5%. He wants to earn a percentage, but that's not yield. They are saying the 3.5% is the discount rate. According to him, the bank's discount should be 3.5%. The bank's discount should be 3.5%. And please understand, if the discount rate is given, it will be calculated on the face value, not on the investment. This is where students make mistake. This is a very easy question, but student will ultimately land up making a mistake by calculating the discount rate on the yield. You can clearly see 5,000 minus X is the total discount for the bank and the total return for the investor. But since we are calculating a discount rate of 0.035, the denominator that will be taken is face value 5000 into 360 by 9. I also told you that when the bank is calculating a discount, for the discount, the bank will calculate it at 360 days. Sir, here bank is not calculating the discount. We are calculating the discount. My friend, even though whosoever is calculating the discount is given by the bank and not you. So if they are saying the discount rate is 3.5%, we have to think from their angle, and their angle is 360 days. So what you did is you assumed this rate to be per annum. And then you converted that per annum rate into 91 days. Or we can say that we converted this return of 91 days, this discount of 91 days into 360 days. So your issue price will come to 4955.76. That means if you pay this much of the amount, this minus this will be your discount. And if you want to calculate the discount that you have received, 3.5% will be the discount on 5000 for 91 days with this price. Okay, but remember this thing, 5000. So I think there in all these three questions, I think there are only two things which you need to remember while revising the question. First of all, please write down in your compiler itself. First of all, from the bank's angle, discount is calculated on face value and they take 360 days for that. From the investor's angle, yield is calculated on issue price and we normally take 365 days. So these are the only two things that you need to remember for all the three questions. Now coming over to question number 114. Again an interesting question. Wonderland Limited has excess cash of rupees 20 lakhs, excess, which it wants to invest in the short-term marketable securities. Expenses relating to investment will be 50,000 rupees. Now understand, 20 lakhs is the excess cash that they want to invest, but while investing 50,000 will be something that they will have to bear as an expenses. The securities invested will have an annual yield of 9%. 20 lakhs into 9%. Annual 1,80,000. Okay. Then the company seeks your advice as to the period of investment so as to earn a pre-tax income of 5%. Before paying any taxes, if you want to earn 5% on your investment, for how much period you will have to keep it invested? So practically speaking, 5% on 20 lakhs will come to 1 lakh rupees. Okay. So you will have to first earn something from that investment, and after deducting the expenses, you will also be deducting the expenses relating to the investment. The balance left should be 1 lakh rupees. The pre-tax income should be 5%. So the major interest income minus expenses should be 5%, and that 5% is nothing but 1 lakh. So understand the logic here. You will need to earn 1,50,000 rupees, my knowledge. And from that you will be deducting 50,000 rupees. The balance will be 1 lakh rupees before paying taxes, which will come to 5% of 20 lakhs. Right? So how much you have to earn from 20 lakhs is 1,50,000 rupees. Okay. But the yield that the bond will or this instrument will produce is 1,80,000 rupees. 20 lakhs into 9%. So if you keep invested for the entire year, you will have to you will be getting 1,80,000, but you don't want to receive 1,80,000. You want to know the time when you will be done with earning of 1,50,000. So it's obviously, if 12 months is there for 1,80,000, how much will be there for 1,50,000? That is the number of period. So if you want to do the calculation, it's very easy. Right. 12 months for a 1,80,000. So how much for 1,50,000? The answer will be 10 months. But that is a different way of calculation. But understand, this is going to be your formula. 20 lakhs into 9%. This entire thing will give you 1,80,000. And you want a period of investment P by 12. This 1,80,000 is entirely for 12 months, right? So you don't want to stay there for 12 months. You want to stay there only till P. So that this entire figure will be 1,50,000 minus 50,000 and that to 1 lakh, which will be 5% of the pre-tax income. It's very simple question. The ultimate goal was this 1 lakh rupees. So you kept the 1 lakh here. But you wanted to earn this 1 lakh before taxes and after all the expenses. So practically speaking, you don't have to just earn 1 lakh, you will have to cover this much also. So this 1,50,000 becomes 1,50,000, which should be earned from this investment. That's the simple question. The minimum period for the company to break even its investment expenditure over time value of money. See, investment expenditure is 50,000. So you'll have to calculate the time where you will be earning 50,000 from your investment. You will be deducting 50,000 expenses, and this will be called as the break even time, where your profit and losses will be nothing. So you want to know, in the previous part you calculated 10 months was there for 1,50,000. So how many months will be there for 50,000? 3.33. And it's simple. 50,000 should be earned so that we can deduct our expenses of 50,000 and the net will be no profit, no loss. Right? That is what the question is asking. Break even means no profit, no loss situation. And when it will be achieved? When our expenditure of 50,000 is recovered from the interest. So we will have to earn 50,000 and then apply the same thing. Keep 0, that's it. And 3.33 months will be required for that. Instead of doing all this thing, what you can do is, see, it's very simple. 1,80,000 for 12 months. 1,50,000, how many months? You do the cross calculation. Okay. 1,80,000 for 12 months. And how much for 50,000? You do the cross calculation, you will still get the answers. Okay. 115 will be your homework. I will just shift to 116 now. Have a look. Hello. So have a look. Z Company Limited issued a commercial paper worth 10 crore as per the following detail. Commercial paper is something which doesn't have it doesn't have a coupon rate. Okay. First, and it is issued at a discount, because if it doesn't have a coupon rate, its face value will be the only thing you will be receiving at the maturity. So today, if you are purchasing that commercial paper, you should purchase it at discount. So the difference between the discounted value and the redemption value will only be your gain. Okay, return, whosoever is investing. So that 10 crore rupees that you are looking there is not something that the company received in the beginning. 10 crore is something that the company will pay at the end. They might have issued it at discount. That is called as a discount. Okay. As per the following details: date of issue 16th January 2019, date of maturity 17th April 2019. Fortunately, they have already calculated the number of days. Otherwise, I was about to start the calculation. Interest rate is 12.04% per annum. See, they have not given you the discount rate. It is interest rate. We will consider it as yield. And if we consider it as yield, it will be applied on the issue price. If they would have written it as a discount rate, the calculation would have been simple. I would have just discounted 12.04% per annum. And first I would have calculated 91 days and then discounted it from 10 crore rupees. But no, this interest rate will be applicable on the issue price. We will assume it as yield. So first what we can do is calculate the 91 days rate and then assume that it will be applicable on the issue price. And the calculation is very simple. See what they have done. Company had issued commercial paper worth 10 crore. Those who didn't read theory, they will assume that company has received 10 crore rupees in the beginning. That's totally useless. 10 crore rupees will be given back at this date, although they have issued it at this point. That's what we have to calculate. Na? What was the net amount received by the company on issue of commercial paper? It should be something which will make the investors return equals to 3.002%. And what is 3.002%? You just converted this 12.04% from 365 days to 91 days. So 91 days return should be this much. So can I say x into 1.03002 should be equal to 10, and the answer is done. You so much of the calculation, man. You don't have to do anything like this. Just put like this: compound amount is equal to principal in bracket 1 plus r. Principal you don't know, compound amount is here, 1 plus r, 1.03002. If you will take it on that side, it will look like this: 10 divided by 1.0030002. So the answer comes to 9.70855. It will match with this. Are you okay with the concept? The only change that they could have done they will do in the next question or in the exam is, instead of writing interest rate, they will write discount rate. Understand? If there is a discount rate, the calculation will be simple. If it is a discount rate, 12 crore, understand, 12 crore less 3.002% on the calculator will be your final answer if it's a discount rate. So that's the easiest one. So question number 116 is over. 117, have a look. From the following particulars, calculate the effective rate of interest per annum as well as the total cost of funds to Bhaskar Limited, okay, which is planning a commercial paper issue. Issue will be done at 97,550. Face value will be 1 lakh. The difference between these two will be the income of the investor and interest cost for the company. How much? Let's have a look. 1 lakh minus 97,550. Can I say 2,450 will be the cost to the company? And this interest is calculated on 97,550. If they would have said discount, it would have been calculated at 1 lakh. Okay. So 2,450 into 97,550 into 100%. But this is only for 3 months, man. Right? We have to calculate it on per annum basis, so we can do it 12 by 3. That is just a normal rate of interest, and it is not called as effective rate of interest. Please understand. Effective has a different meaning to it. So let's first calculate this. 2,450 divided by 97,550 into 100. That will be 2.5115%. And this is for 3 months. Okay. 3 months means there are, in case of effective compounding, we can say this as a quarter period. Now what we can do is 1 plus r to the power divided by n to the power nt minus 1 will be effective rate of interest. That is what you have learned in the time value of money. So can I say that how we are going to do it? This is already for 3 months, right? This is already for 3 months. So r by n will also be for 3 months. Can I write down like this? 1.025115. R by n itself is 2.5115%. R by n. Okay. To the power nt. N means 4. Time is 1 years minus 1. So it will be like this: 1.025515 into 234 minus 1. So the answer will be 10.60%. Compounded effectively. Was there any mistake from my side? Let me just check it. 1 lakh minus 97,550. Okay. It should be 2,450 divided by 97,550. So it was 0.02551. Right. Okay, this is the rate. So if you convert it, they have actually multiplied it by 4 and they have written this as a per annum rate, but rounding of difference is there. Okay, I got it. That's a rounding of difference. See, I will tell you. Multiplying this by 4 and dividing it by 4 should give you the same answer. But if you will understand 0.1005 divided by 4, this comes to 0.025125. So the last two digits of 25 and 15 is making all the difference. So don't go with this. They have first multiplied and divided and changed the answer entirely. 10.60% should be the proper answer here. Effective rate of interest. Do you know how to calculate effective rate of interest? Is nothing but 1 plus r divided by n to the power nt. R should be per annum rate, right? And r by n should be the quarterly rate. This is the quarterly rate, 2.5115. So this is just the interest cost which the company has to bear on this. But apart from that, the company also has to bear brokerage, 0.15% for 3 months. Can I say that for entire year it will be 0.60%? Okay. Rating charges are already given as per annum and stamp duty is already given as 0.175 for 3 months. So we can just multiply it by 4 to arrive at 0.70%. So 0.6, 0.5 and 0.7% are the charges per annum. Okay, so what is the total cost to the company? So total cost to the company is first they have to bear this 10.60% per annum. Then they have to bear this one also. So what we can do is the total of all these year. Instead of this, you can write down 10.60%, this, 657, and the total is 12.235%. Simple. This is the cost to the company. This is the only interest cost of issuing the bond. But apart from the interest cost, they have to bear the brokerage, rating, stamp duty, etc. So what you are going to do, you are going to add everything. But please make sure all the costs should be on same time basis. Brokerage was for 4 months, 3 months, we converted it into 4 months. Stamp duty was for 3 months, we converted it into 4 months, 1 year. So that's when we can add up. Okay. So question number 117 is complete. 118 will be your homework. 119 is going to be the next question. It's again the same thing. Okay, just have a look on this. See, AXY Limited, this is another question. AXY Limited is able to issue commercial paper. Now this commercial paper which is issued, it is issued at a discount, okay, for sure, of 50 lakhs every 4 months at a rate of 12.5% per annum. Now this rate is a discount rate or an interest rate. If it is a discount rate, this rate will be applicable on 50 lakh rupees, and if it is interest rate, it will be applicable on issue price. See, whenever there is, I can say, whenever there is no clarity about such rate, whether it is discount or interest, assume it as interest rate, or we can say it is yield, and it is applicable on the issue price, that 12.5% per annum. So 50 lakh includes this much of the amount. So we can say that 50 lakh is on 112.5%. But that's for the entire year. 12.5% is per annum. Okay. You have to find out exact rate for 4 months. So what you can do is, for 4 months, the rate will be 12 multiplied by 4. 12.5 divided by 12 multiplied by 4. So it comes down to 4.167. So this 50 lakhs will be 104.167%. So the moment you will divide 50 lakhs with 104.167%, you will get 48 lakh rupees. Means the 100% value. This is going to be the issue price, on which the interest will be paid at 12.5% or 4.167%. If you add 4.167% on 48 lakh rupees, it will come to 2 lakh, and this way 50 lakhs will get completed. So today investors will have to pay 48 lakhs. After 4 months they will earn 2 lakhs, and along with 48 lakhs and interest of 2 lakh, the company will redeem 50 lakh rupees to them. Okay, that's the thing. But the cost of placement of commercial paper issue is 2,500 per issue. So this is another expense. From the company's angle, 2 lakh rupees is the interest expense and 2500 is also an expense. AXY Limited is required to maintain line of credit of 1,50,000 in bank balance. So the moment 48 lakhs rupees will be credited in the bank, out of this 48 lakh rupees, 1,50,000 rupees will be permanently stored in the bank itself. You cannot use that money. So 1,50,000 rupees is unusable. It's not usable. Okay. In bank balance, the applicable income tax rate is 30%. What is the cost of the funds? Cost of funds after taxes. Please understand, after taxes means the tax saving on 2 lakh rupees because this is an expense, the tax saving on 2500 also because that is also an expense. There will be no tax saving on 1,50,000 or tax payment on 1,50,000 as this is not an expense, not an income. This is just the balance that we have to keep in bank all the time until the end of the 4 months, and then it will be returned back to the investor. So practically speaking, this 1,50,000 is as good as not given by the investor, and still we are paying the interest to them. In that interest is included in this 2 lakh rupees because we will be paying interest on 48 lakh rupees, and out of that 48 lakh rupees itself, the 1,50,000 will be stored in the bank forever. Right? So we are already paying already paying interest on 1,50,000 to the investors, but we are not getting that amount to be used for our purpose. Okay. The applicable income tax rate is this cost of the funds has to be calculated. How do you calculate the cost of the funds? It's very simple, sir. Put cost in the numerator and funds usable funds in the denominator. The funds that you can use. You are not getting 50 lakh rupees to use for the purpose of business. You're also not getting 48 lakh rupees for the purpose of business. I will tell you how much exactly is the amount that you can use. That will become practically or effectively the funds that you are using, and the expenses after tax will be the cost in the numerator. See, issue price is 50 lakh rupees, completely wrong. This is completely wrong. Do not follow this. It was the old answer. Okay, this is also the old answer. Do not follow it. They came up with the alternative later on, and when they realized what is the true answer, they came up with the correct answer in this. This alternative is right. This is the correct answer. See, what problem was there in this? I will tell you. They directly took 50 lakh into 12.5% into 4 by 12, that came up to 2083333. They applied 12.5% on 50 lakh itself. So they said that we received 50 lakh rupees in our bank, which is completely wrong in case of commercial paper. They are paying 2,08,000 above 50 lakh rupees. So what they are treating here is, you received 50 here and you are paying 52.08 here, which is completely wrong. They are not even considering this as a discount. If they would have considered this as a discount, the issue price would have been 50 minus 208,333. But it is not like that. They are saying 50 and above that 12.5% will be paid as an interest. So the repayment that will be made at the end will be 52.08, which is completely wrong. This is also completely wrong because of the same interest, right? And what is right is this: since commercial paper is a discount instrument, if it is a discount instrument, it can be presumed same shall be issued at a discounted price. Exactly. Accordingly, answer shall be, issue price will be 48 lakh. This is the perfect answer. Go with this answer in the exam if the question is asked. These are the old answers and they were wrong at that time. So do not follow this. Do not follow this. Okay. So first of all, 48 lakh rupees is the issue price. So imagine the process. In the beginning, you received 48 lakh rupees, right? Right? Okay, then what will happen over a period? You cannot use 1.5 lakhs out of it. You cannot use 1.5 lakhs out of it. Can you? No, sir. We cannot use 1.5 lakhs. So what is the balance left with you? 48 lakhs minus 1,50,000. So 46 lakhs 50,000 is the only amount that you can use. 46 lakhs 50,000 is the only amount that you can use. Now have a look on this. This is the correct answer. What they have done, I will tell you. issue price was 48 lakh rupees, right? Out of that, they knew we have raised 48 lakh rupees, but we will have to pay 2 lakh rupees as an interest after 4 months. So this is kept aside, right? Out of that, 2500 was paid as an issue expenses. Okay, this is kept aside. Also, minimum balance that was required to be there in the bank balance, kept aside. Out of all these three things which you cannot use, this was the cost and this was the cost on which there will be some tax saving. So practically speaking, you had only 47 500 rupees after deducting all the three expenses, two expenses and the third one, the cash balance. You can use 47 500 only, and for that thing you will have to bear a cost of 2 lakh and 2 lakh and 2500, but you can save some taxes on that. So the cost of the fund becomes the funds that you are able to use in the market, that is 47 500, and in the numerator you will take 2 lakh 2500 interest plus issue expenses, but that too after taxes. You are removing the tax saving out of it. So the numerator becomes the expenses after taxes divided by the amount that I can use, 47 500, and this is all for 4 months. I converted it into 12 months and the rate becomes 9.56% is the correct rate per annum. This is the correct cost of funds. I am also not satisfied with this opportunity cost that they are considering. I am saying it is wrong. Why I am wrong? I am saying it is wrong. Opportunity cost at 12.5% of 1,50,000 for 4 months. Why? I will tell you. I will tell you. This 1,50,000 was deducted from 48 lakhs, right? This 1,50,000 was included in 48 lakhs. You are already paying 12.5% on 48 lakhs. You are already paying 12.5% on 48 lakhs. This 2 lakh includes that interest on 48 lakhs, and this 48 lakhs also includes 1,50,000. That means I can say the interest on 1,50,000 is already included in 2 lakh rupees. Then why there is more interest that we have to take? There is no need to take the opportunity cost on 1,50,000. It was already taken in this 2 lakh. So this answer is also wrong. The only correct answer is this one. Also in that answer you can negotiate one thing, that this 2 lakh rupees of the cost will be paid at the end, not at the beginning. So in the beginning we will be able to use that 48 lakhs rupees entirely. So that's a matter of discussion. Some ambiguities are there in this question, but you have to move on like this. If the question is asked in exam, go ahead with this method. Question number 120 is very easy. Again the same, we have done such type of question. 119 was like that. You have to do it by your own. Question number 121 is the same thing. See, issue price, interest at 15%, issue expenses, minimum balance. I think this answer will also be wrong. If they are considering 50 lakh as the issue price, you have to consider that the 50 lakh is issued at discount. So this answer will also be wrong. You should write down the alternative answer as you solved it in the previous question. Okay. Question 121 is completed. Now coming up to question number 122. Right now we are on the commercial paper thing. Understand? We are done with the treasury bill, right? Then we started some questions. Treasury bill, money market instrument, and now we are done with this commercial paper things also. And now we are on this question 121, I think, right? 121, 122 will again be on commercial paper, and then certificate of deposit will start. So let's have a look. What is the question? It's easy. Two companies are there, XYZ and ABC. Each issues a commercial paper of 5 million rupees, each maturing in 91 days. So 5 million means 50 lakh rupees. And please understand, this will be payable after 91 days. The issue price or issued amount, received amount will be something else. Okay, that's what we have to calculate. While XYZ's commercial paper has a credit rating of A1, ABC's commercial paper has a credit rating of A3 from this credit rating agency named as CRISIL. XYZ and ABC commercial papers are issued at 7.6 and 8.5% respectively. 7.6 and 8.5% respectively. This is, unless otherwise given, will be termed as interest or yield, which will be included in 50 lakhs. Okay. And this is all for 91 days. First of all, you will convert those rate into from 365 to 91 days. And then you will assume that that percentage is already included in that 50 lakhs. Obviously, you are required to determine the compensation for ABC's commercial paper for greater credit risk. Assume number of days to be 365. So please understand what they have done. It's very simple. First of all, they have converted this 7.6% from 365 to 91 days. And then they added it to 1. And the moment they added it to 1, let me do it. 7.6 divided by 365 into 91. That comes to 1.8948%. Okay. So it will go like this. If you do not understand this, let's say X is the issue price multiplied by you are paying this much of the interest. So 1.018948 should be equal to 50 lakhs. Okay. Now, if you keep X on this side and if you transfer this on that side, it will be in the denominator. So 50 lakh and in the denominator 1.018948. Okay. 50 lakh divided by this. So the issue price will come to this. And in this, what is the matter, man? 8.5%, 7.6%. That's it. First step, convert 365 days rate to 91 days. And then understand that the formula should be like this. X into the rate should be equal to 50 lakhs. This is the compound amount, man. Compound amount is equal to principal in bracket 1 plus R. R is that 1.8948. Use that. 50 lakhs is equal to principal 1.0184184948. In the similar way, you will have to calculate. This is all key. These all formulas came from the compound amount formula itself. Okay. Accordingly, compensation for higher credit risk shall be. See, now we will first look at the analysis. XYZ Limited's commercial paper issue was 49.07 lakh. They received this much the amount, and for ABC Limited they received 48 lakhs. So can we understand one thing, that XYZ Limited received more amount? Why? Because the interest rate was lower than the ABC. And also why the interest rate was lower for XYZ Limited? See, XYZ's credit rating was A1 and ABC's credit rating was A3, which is bad. If the credit rating is bad, the interest rate will be higher, that you will have to pay more interest to the investors. Why? I will tell you. If the credit rating is bad, it is deemed that your commercial paper is risky, and if it is risky and you want investors to invest in that, you will have to pay higher amount, that is 8.5%. So question is asking you, how much is the compensation for ABC's commercial paper for greater credit risk? Because it has a higher risk, the higher return that they are paying as compared to XYZ is 10,783. That means ABC Limited is paying this much of the extra amount to the investors just because their commercial paper rating is not A1 but A3. Just because of that. So the everything else is same. So we can say that the amount of difference, the value of this credit rating is 10,783. Okay, move on to question number 123. This is simply calculating effective yield. Rate of discount is given. Certificate of deposit is the similar. 100 is the amount of issue. 100 will be paid after 6 months, and the discount should be 20%. Understand? And this discount will be assumed as per annum. So for what we are saying, for 6 months the discount will be 10%. Am I right? So 10% discount will be that 90 rupees. And you have to calculate yield, means the return. Return is 10 rupees on 90. Calculate 10 on 90 is 11.11%, that is for 6 months, multiplied by 2, it will be 22.22%. How difficult is this? Nothing. Question number 124. Let me check first if I need to do it, or else I will just leave it for the homework. Homework, man. Easy. In this case, yield is given. In the previous question, 22.22% yield was calculated by us. In this question, the yield is given to you. You have been asked to calculate the issue price or the amount to be invested now. From the investor's angle, it will be the investment amount, right? 80 lakhs will be paid at the maturity. This is certificate of deposit. Certificate of deposit, it will be issued at discount at such a price where, if let's say for example X is the investment price, right? If you are investing X amount, your earning should be 8% per annum. That's it. And the total is 80 lakh that you are going to receive at the end. You calculate the issue price. It's very easy. 125. Discount yield. See, discount yield means it will be applicable on face value. 6%. Have a look. A bond is held for a period of 45 days. This is a period of 45 days. The current discount yield is 6% per annum. It is expected that the current yield will increase by 200 basis point and the current market price will come down by 2 rupees 50 paisa. Now they are saying yield will increase by 200 basis point. Don't think this is the yield. Okay, so this is quite interesting question. We are going to solve it. Have a look. A bond is held for a period of 45 days. Okay. The current discount yield is 6%. Underline the word discount. So it will be applicable on the face value. It's not just yield, it's a discount yield. Is 6% per annum. It is expected that the current yield, this yield, will increase by 200 basis point. If 6% increases by 200 basis point, that means 2%, it will become 8%. And the current market price will come down by 2 rupees 50 paisa. If you increase the YTM, not just the YTM, the discount rate by 2%, market price will come down by 2 rupees 50 paisa. Okay. Find out the face value of the bond. They have not given you the face value. How will you calculate? It's very easy, sir. It's very easy. Have a look. 125. Let's say X is the face value. Okay. X is the face value and 6% is the per annum rate. And if we calculate for 45 days, na? Okay. So we can do so. Let's take 6% for is a per annum rate, and if we take 360 days in a year, for the sake of understanding, otherwise you can take 365 also, for the sake of simplicity, and you convert it into 45 days, the rate will be 6 divided by 360 into 45. The rate is 0.75%. And if it goes to 8%, the 45 days rate will be 1%. So you can clearly see there is a difference of 0.25%. There is a difference of 0.25% in the discount. In the discount that we are applying on X. But please understand, 0.75% will be reduced from the face value. This is nothing but the face value, and this will give us the issue price. This will also give us the issue price. Okay. So if we reduce this, it will look like this. X in bracket 1 minus 0.00 0.75 divided by 100, 0.0075. Am I right? If we reduce 0.75%, and this will be like this. X in bracket 1 minus 0.01. Okay, true. And then they said that the current market price will come down by 2 rupees 50 paisa. So whatever was the market price, this was the market price, man. This was the market price at which you issued, and it will come down by 2 rupees 50 paisa. So this minus this will be equal to 2 rupees 50 paisa. And then calculate x, that's it. Let's find out. X in bracket 1 minus 0.0075 minus x in bracket 1 minus 0.01 should be equal to 2 rupees 50 paisa. Should be equal to 2 rupees 50 paisa. Let's solve it. This is x 1 minus 0.0075. So this is going to be 0.9925x minus 0.99x is equal to 2 rupees 50 paisa. 0.0025x is equal to 2 rupees 50 paisa, and x is equal to 1000. This is your face value. Face value is 1000 rupees, and that's how this entire calculation is arrived. Simple, very simple. We converted the 6% into 45 days rate, we converted 8% into 45 days rate. Then we saw that these rates are discount rates, and that's why we took face value as x, and this is applicable on x. So x minus 70.75% will be the market price. Again x minus 1% will be the market price, and the difference between these two, the question is saying, is 2 rupees 50 paisa. So we created an equation and we found that the face value is 1000 rupees. Very simple question. Now bond equivalent yield. Now they are asking you to calculate the return. But in which rate? When the discount is 6% or when the discount is 8%? If the question is not specific, calculate the return in both the cases. And yield is calculated on market price. Ladies and gentlemen, please understand. Okay. First of all, now we will write down a couple of things. At 6%, okay, market price will be 1000 in bracket 1 minus 0.0075, 992.5. Am I right? This is the market price, and at 8% market price will be 1000, 1 minus 0.01, that's 990. Okay, this is the market price. This is the investment on which the yield will be calculated. So at 6%, yield will be calculated as return in the numerator and market price in the denominator. Yield is calculated on the return investment. Investment is 992.50 and 7 rupees 50 paisa. Am I right? 1000 minus 7 rupees 50 paisa. That into 100. 0.7557%, and at 8% yield is equal to 990 in the denominator and 10 rupees in the numerator. 1000 minus 990, 1.01%. But that is only for 45 days. So what we should do is this. Into 40 into 360 divided by 45 into 360 divided by 45. 6.05%, 8.08%. Finish. The game is over now. Let's check the answer. They did it the same way. 6.05, 8.08 and 1000 rupees is the face value. They had their own way to calculate, but it's easy. Now this is the question which has been solved in both the cases, like taking 360 as the days in a year and taking 365 days in a year also. So you want to do it your way, you can do it. Question number 126. Again the same thing. See, face value 100, discount yield is 6% for 45 days. That means 0.75% if you take 360 days in a year. If you take 360 days, so 99.25 is the current price. Equivalent yield you can calculate, that is the base denominator will be 99.25 in this case. This is the return, that was the discount, this is the return that was calculated on face value, this will be calculated on the investment amount. And effective annual return means you will have to take 1 plus r divided by n to the power n t minus 1, compound it again and again, and you will calculate the effective annual return. See, the bond equivalent yield will come down to 6.045% per annum without any compounding. This will include the compounding. What you did here is you just multiplied by 360 and 45. That doesn't include compounding. It's like 2% in 1 month, so 24% in 12 months. No, that doesn't include compounding. This includes the compounding, 1.02 to the power 12. This will give you a different answer. This includes compounding, this doesn't include compounding. That's the thing. Okay, 126 is over. 127 is going to be another question. Now please understand, there are only 4 questions left in this question and only one concept. Please have a look. We are done with these questions: commercial paper, certificate of deposit, and the last 2 questions were bond value and the bond equivalent yield, discount rate, and all that thing. Now there are, I think, 1, 27, 8, 9, 10, 5 questions left, and all of them are on repo. What is this repurchase agreement? Repo rate and reverse repo rate you need to understand. So please make sure that you have read the theory from theory book, otherwise it will be very difficult for you to understand. First. Second thing, you know the dirty price thing? Yes sir. Okay, that's good. Then there are a couple of things that I should explain. Dirty price, clean price, so we have already done first leg and second leg. Okay, so I will give you an idea about this after this break, and then we'll start with question number 127. Okay, so I think let's first discuss about the repo and reverse repo rate. Cool, have a look. What happens? It's very easy concept, so won't take much of the time. Let's say, for example, this is one bank, this is another bank, and this is the first bank again. Okay, bank 1, bank 2, bank 1. Now what happens is, the purpose is very simple. We need fund. The bank 2, let's say for example, needs some funds. So what happens? They will get the funds from bank 1. The bank 1 will transfer the funds. Obviously they will not transfer it free of cost. They will keep the securities. They will buy the securities, some short-term securities from bank 2. So in a sense, we will say that the owner of the securities, which was bank 2, these securities will be sold by the bank 2 to bank 1. But these are not a permanent sale agreement. This will be called as the repurchase agreement, repo. So repurchase agreement means what? That you give me funds at a certain rate, let's say 4%. You give me funds at a certain rate, and till that time I'm selling my securities to you as a guarantee. Obviously this is basically pledging the securities, but it is treated as a sale. Okay, and after certain period of time, let's say 14 days, I will repay the funds to you at an interest. This will be called as repayment. This will be called as repayment. And I will buy back my securities from you. So this funds when received from bank 1 is called as the first leg of the transaction. When you repay it to the bank, it's called as second leg of the transaction. Okay. Also, one more thing. Let's come to the amount. Let's say, for example, the securities that you sold to the bank 1 was worth 105. Was worth 105. Now you remember one thing. Just a second. Okay. So you remember one thing. At any point of time when you sell the securities, that 105 will be called as the dirty price of the security. That will be called as the dirty price of the security. That includes accrued interest and the clean price of the security. Let's say 5 and 100. Okay. Clean price of the security. Now tell me one thing. You are giving the securities worth 105. You are giving the securities worth 105 to bank 1. How much money the bank 1 should give to you in place of that? The funds that the bank should give you in place of that. Do you expect the bank should give you 105 rupees? No, sir. The bank will not do that, because the securities which is worth 105 today may fall in prices, and tomorrow, let's say for example, you have taken the funds or a loan from bank 1 for 14 days. So after 14 days, if bank 2 is unable to make the payment to bank 1, this bank 1 will sell the securities in the market, and there are chances that it will sell at a lower price. So whatever the expected price will be, let's say for example, we are expecting, or the bank 1 is expecting, that this 105 can maximum fall to 102 rupees. So covering that, the bank 1 will only issue 102 rupees to bank 2. This 3 rupees of the deduction, there is a 3 rupees of the deduction which will be called as haircut margin. Haircut, or you can say initial margin. That is for the safety bank has kept with them. So if you give them the security of 105, they will lend you something which is something after we can say they will lend you the amount after deducting haircut or after keeping some deposit. So that is 102. Now 102 is the first leg, and if you add 4% interest, you will pay back, let's say for example 104. 102 plus 2 rupees of the interest, hypothetical figure, and once you pay back 104 rupees to bank 1, you can buy the securities back from them at free of cost, whatever will be the market price at that time. But please understand, for those 14 days the bank 1 had the bond with them, they will keep the interest for that, right? We'll talk about it later on. Now these are the things in the repurchase and repo and repurchase agreement. Now this 4%, understand, this 4% is called as, this agreement is called as repo rate. 4% is the repo rate. Repo 4%. Okay, understood? This is the repurchase agreement between the two banks. Now we are going to see lots of things out of this in the questions. Have a look. That is just a basic understanding. More of it will be covered in the questions. Okay, so before starting this question number 127, I think we should go with question number 129. See, there are 5 questions: 27, 28, 29, 30, 31. 30, 31 will be on the similar ground. So at first itself you can take it as homework. 30, 31, 31 as well, and 29, 28 and then 27. This is how we are going to go, so that we will first look at the easiest question, we will understand the topics, then we will move to a difficult one. Question number 129 in front of you. Bank A enters into a repo for 14 days with Bank B. That means Bank A and B are going to exchange some funds and the securities for 14 days. Okay. In 12 with Bank B in 12% Government of India bond 2017 at a rate of 5.25% for rupees 5 crore. Have a look. The repo period is 14 days. Repo rate is 5.25. This is repo rate, and 12% is the coupon rate on Government of India bonds. The nominal amount is 5 crore. Nominal amount, or you can say face value. Assuming that the clean price is 99.42, this is not a dirty price. The transaction will happen at a dirty price. So what you have to do is you have to add the accrued interest, if any, in that price, and then first arrive at the dirty price. Initial margin will be 2%, means whatever the dirty price is, out of that dirty price 2% will be kept aside and the balance can be given to the other bank as a funds, and days of accrued interest be 292. So they have clearly said that the 292 days accrued interest is there. So first we will calculate the accrued interest. Have a look. Yeah, one thing which is not given in this question is the face value, which is 100 rupees per bond assumed. Second, the first thing that they have asked is dirty price, then start proceeds, that means first leg, and then the second leg. So first we will calculate the dirty price. Without that we cannot calculate the start proceeds. Without that we cannot calculate the repayment of the maturity. This is the amount that we have borrowed today and this is the amount that we are repaying along with the interest. So what you are going to do, add interest for 14 days in this amount and you will get the second leg. So everything is easy. Number of days in a year has to be taken as 360. So let's calculate the coupon amount first. Okay. With the clean price of 99.42, you can easily assume that the face value will be 100 rupees. 100 rupees into 12% of the interest will become annual interest, and 292 divided by 360. 100 into 12% into 292.360. This much of the amount will be called as accrued interest. Do you agree? And when this accrued interest will be added in the clean price, we will call it as a dirty price. So each bond is worth 109.1533. This 5 crore is the face value, you can say nominal amount. Now, how much amount we will receive from the other bank? It's very simple, sir. Convert your bond into a market value. What is the market value of the bond that you are selling to the other bank? Out of that, 2% will be kept aside and the balance will be given you as funds. So first of all, is 5 crore a market value? No, sir. 5 crore divided by 100 will give you number of bond, multiplied by 109.1533 will give you market value, and less 2% margin will give you the first leg. So understand the formula. First leg, or we can call it as a start proceed, nominal value which is 5 crore divided by 100 means the number of bonds, multiplied by 109.153 means the market value. Now this much of the amount will be called as the market value, and now you can clearly see 100 minus 2 divided by 100, or we can write down 98%. Simply 2% has been kept aside and 98% of this market value of the bonds will be released as the funds to you. So this is the first leg. Now what is the second leg? Second leg means repayment after 14 days. So 5.25 is the repo rate which you will apply for 14 days in 360. So this much of the amount into 5.25% into 14 divided by 360. That will give you the answer. Very easy. See, this much of the amount start proceed into 5.25 into 14 by 360 and you have the repayment. Got it? Very easy. Nothing to be scared of. Now coming over to question number 128. On 30 June 2015, PNB Bank proposes to borrow a certain sum of money. Underline, borrow a certain sum of money. It is nothing but the first leg that they want. Okay. From CB Bank for a period of 14 days. Again 14 days at 12% per annum. This 12% will become repo rate. And this is repo period. Against 13.5%, this is coupon rate. Having a face value of 400 crore, which is currently trading at 410 crore. Okay. Maturing on 30th September 2015. So this is 30th June. Okay. Now the coupon dates are 30th April and 30th September. Now you can clearly see after April, 31 days of May and 30 days of June has already become the past, or we can say that has already gone. So we are standing right now at 30th June. That means 61 days interest is accrued. The last interest paid was on 30th April and now we are on 30th June. That means 61 days accrued interest has to be calculated. Okay. You are required to determine the amount of borrowing, that means the first leg, and buyback price of the security. After 14 days, the securities that you are going to buy back, what is the price of that? They are not saying calculate the second leg. Second leg is different, buyback price of the security is different, sir. We will talk about it in a moment. Now understand how much money you will receive. Currently the market value of the bond is 410 crore, plus the interest amount can be accrued. So we can easily calculate the first leg. See, 410 crore is the worth of the bond, plus interest for the period of 30th April to 29th June means 61 days. They should have taken 30th June itself directly. Divided by 360 into coupon rate into face value. So for the 61 days accrued interest has also been taken. Now, if you are taking this accrued interest, that means this is clean price. And this has become the dirty market value. No other option than to assume this. Because if you say that 410 crore of the bonds or the securities are at dirty price, then this entire information becomes irrelevant and you cannot add accrued interest in that. My suggestion or my take on this is it should have been clearly mentioned in the question that 410 crore is on the clean price, not on the dirty price. Normally it always is on the dirty price, but in this question they have taken this market value on the clean price. That's the main reason we have added interest separately. Otherwise there was no need. So 419.15 crore is something that you will take. Okay, this is your what I can say is first leg. There is no haircut, there is no initial margin which has to be kept aside. Cool. Then at the time of repayment, what will happen? You have borrowed this much of the amount. So the amount of loan is 419.15 crore. Obviously you have kept this loan for 14 days and you will have to pay the interest for 14 days at 12% on this 419.15. That interest comes to 1.9560 crore. So the total repayment, or you can say the second leg, will be this much. The second leg that you will be paying is 421.106 crore. But the question is not asking about the second leg. They are asking out of that second leg, how much is the securities value and how much is the interest accrued. Because understand one thing. If you are borrowing on 30th June, it means 14 days from there, 14th July is the repayment date. Okay, now understand. 1, 2, 3, 4, 5, 6. This is April, May, or 30th April, it was. Okay. 30th April, 31st May, 30th June and 31st July. Okay. Now, you sold the bonds at this date and you purchased it back at this date. We can clearly say that the accrued interest now is for this much of the period included in the bond. So market value of the security today will be how much? The amount that you are paying minus the accrued interest. This is going to be the buyback price of the security. This has nothing to do with the market value of the security. This has nothing to do with the second leg amount. It is just for the purpose of your calculation that this is going to be the buyback price, or we can say the cost of the securities excluding the interest. So we can clearly see 30 days of May, 31 days of May, 30 days of June and 14 days of July. So 65 days around are the days. 65 no. 31, 30 plus 14. So that comes to 75 days. Instead of 13 July, it should have been 14 July. Okay. So 75 days of the interest at 13.5% on the face value of 400 crore comes to 11.250 crore. So basically we got our bonds back. It was just lying with the other bank for 14 days, and still the interest income is now ours because the interest is not yet paid by the company or the other issuer of the bonds or whatever it is. So that interest will also become ours. So practically speaking, the cost has been 409.856 crore. This is the buyback price of the securities. This is the price of interest that you have paid. So this was the interest amount out of that which has already been accrued in 421. So in a sense we can say that we are just taking the price of the securities that we are getting back is only 409.856. 409.856. We gave him 410 crore worth of securities and we are getting back 409.856. The difference is 0.144, and this difference is nothing but the difference between I can say that interest on, I can calculate this. Just have a look. For this much of the period, any 14 days, the other bank kept our securities. So 400 crore into 13.5% into 14 days interest comes down to 2.1 crore, right? But he is eligible to, we can say, pay this much of the amount, and out of that in 419 crore was the amount that given by him, and he is eligible to receive 1.9560 from us. 1.9560. So if you will calculate the difference of it, you can say 0.144 is the exact difference. So that's the answer of this question. This question 128 is over. Now have a look on 127. On 30th June 2015 PM, this is a little ambiguous question, so there might be some problem. Okay, let's discuss it first. 30th June 2015, again it's June, it was also June. Okay. PNB Bank proposes to borrow a sum of 400 crore from CB Bank via repo rate of 11.65%. Similar question. But the 400 crore worth of amount is already given and we want to borrow it. This is already first leg given in the question. Understand? In the previous question, question number 129, do you remember the first leg was calculated by us? This is the amount of borrowing. 534,85,117. But the amount of borrowing this time is already given to us in the question. Okay. And that too at a repo rate of 11.65%. Okay. Using 10% government, this is going to be coupon rate. Right, this is coupon rate, this is repo rate. Face value 10,000 for a period of 14 days, again with a 3% haircut. Okay, current price of the security is 9872. Now there is one problem in the question. They have not mentioned whether this is dirty price or clean price, but the answer says this is a clean price, and this is an ambiguity in the question. You might take it as a dirty price. So what the student should do in exam, put a note. Whatever assumption that you take, in the absence of any information, you should put a note that we have assumed it as a dirty price or a clean price. Okay, if you assume it as a dirty price, there is no need to add accrued interest again, and that will make lots of information irrelevant. My suggestion is, looking at the questions I have seen, looking at these questions, we can assume it as a clean price. The coupon dates are 30th April and 30th September, exactly like this. 30th April and 30th September. So we can say this one is also a period of 61 days. Accrued interest period in this question is also for 61 days. Now you are required to calculate the nominal amount. This is the face value that we want to calculate. Understand? In the previous question, if you remember, in this calculation, the nominal value was given in the question, which was 5 crore. Now this is something that we have to calculate now. 400 crore is already given to us. This value is given. We have to calculate this one. Okay, one thing. The next thing is they also want us to calculate the number of securities. It's very simple. Once you calculate the face value divided by the face value of 10,000, you will get the number of securities. But there is again a problem in this question. They have not divided it by 10,000. some other figure only they have taken. So that is also an ambiguity. To be delivered in the beginning of the repo, the cash amount to be repaid at the end of the repo. This is very simple question. Since you have borrowed 400 crore rupees, understand, 400 crore rupees, you will have to pay 11.65% on that. So 1.1, I will just take it in this manner. 400 crore, this is the principal that you will pay, plus 400 crore into 11.65% is the per annum rate, into 14 by 360. This is going to be your cash amount to be repaid, and this is going to be second leg. This is the very easy answer, but the first one has some problems. Okay, let's find out. First of all, we calculated dirty price. Accrued interest for 61 days on 10,000 rupees of the face value, 10% coupon rate, 61 days come down to 167. That 167 was then added to the clean price. This was the clean price they have assumed. So we have reached at the dirty price. Now the ambiguity will start. They have adjusted the dirty price like this: 10,039.12 divided by 1.03. In the previous question, what we did is, this was our dirty price, and we directly multiplied 98% with that. If we go this way, what we will do in this question is, we will keep 10,039.12 as dirty price, and we will multiply it with 97%, because 3% is the haircut. 3% will be kept aside by the other bank. If you will go on Investopedia, if you will search an example for haircut on Google, they will also suggest like that only. But what is happening here is 3% is assumed to be included in 10,039 already. So that's why they are dividing it by 1.03 instead of multiplying it by 97%. This is the first ambiguity. Okay, one thing. So this answer according to us is wrong, whatever it is. Now they started calculating the nominal amount. Okay, you might not understand this formula, but if you will put down the figures in this formula, you will get to know about it. This formula. Let's do it. What was our formula? Amount of borrowing were put on the left hand side. Then this is X nominal price, nominal amount that we required, into dirty price divided by the face value, which is 10,000. Okay, but now in what is happening in this question, instead of multiplying it by 97%, they are doing something like this. They are taking 103 minus 3 divided by 103. What happened in the previous question was, we took it like this, and most of the part is done like this only. 100 minus 2 divided by 100. Why 103 minus 3 divided by 103? But we can't help it. This is the this is the first ambiguity. So they have done it like this. If you will solve this, if you will put 400 crore here, and if you will put 10,039.12 here, you will get the X, which will be this much. 410.39447 crore. This is supposed to be the face value, total face value, right? This is supposed to be that 5 crore rupees. Now this is reached. One first answer has been arrived. Now number of securities required. Again they are dividing it by 9746.72, which according to me is wrong. It should be divided by 10,000, because once we have already arrived at the face value, it should be divided by the face value only. See what is happening in this part. 400 into 10,000 divided by 9746.72. This answer has been taken here, again divided by 9746.72. So practically speaking, if on this place, if you put this entire example, it will look like this, and you will understand why it is wrong. 400 into 10,000 divided by 9746.72 divided by 9746.72. What is the logic of this? If this 9746.72 comes down to the denominator, it will look like square of this. Doesn't make sense. It should be 10,000. This should be 10,000. I understand the above figure, but the denominator, the last denominator should have been 10,000 if we are calculating the number of securities. Face value has to be divided with the face value. So that is the second issue. So there are some problem in this question, but I hope that it will not come in your exam. No problems are there, no issues are there in the rest of the question. So 128 has been solved. 127, I told you there will be some ambiguity. 126, 129 was easy. 130 is also again easy. In the previous question we had, before this 130, we had dirty price, first leg, second leg. In this case, only dirty price and the second leg is there. But please understand, you cannot calculate the second leg before calculating the first leg. So obviously they will have to calculate the first leg here, and the second leg has been calculated here. Got it? Similar question. And the 31 is easy. You have to calculate the repo rate. This is the reverse calculation. Please understand. Let's not take it as homework. Let's solve it, because this was asked in the exam July 21, and this is a reverse calculation. First leg has already been given to you, right? Second leg is also given to you. Initial margin is also given to you, and days of accrued interest are also given to you. Now the bank BK enters into a repo for 9 days only. Okay. In 6%, this is going to be coupon rate for an amount of 2 crore. This is going to be the face value. Now we have to calculate the repo rate. Can we calculate it? But I think before calculating the repo rate, we have to first understand everything. Second leg, calculation of the second leg. See, if you have to do the reverse calculation, I think what you should do is, in the previous calculation, you should start from second leg. In the previous question, we started from dirty price, then first leg, then second leg. Now you start from second leg, then calculate first leg, and then you can calculate the dirty price. Okay. Second leg can be easily calculated with this. This is going to be the repo rate. You put down this formula. You put down second leg is equal to start proceed into this formula. You will get the repo rate. See. Everything is given. Second leg is given, start proceed is given. This is the rate that we need. So we have calculated the repo rate. Now come to the start proceed. In order to calculate the dirty price, we have a formula of start proceed. Start proceed is equal to the nominal amount into dirty price divided by the face value. Have a look. Nominal amount, this nominal amount of 2 crore into dirty price by 100 into 100 minus initial margin. It is exactly like this. This is going to be 120. How much percent? 1.25% now. So it will look like this. 100. It should be like this. So make a correction here. It should be 1.25. Right? And you will get the dirty price. Reverse calculation. Once you get the dirty price, you have the interest accrued, you can calculate the clean price. This question is very easy, but all the calculations are in reverse method. So you will have to just use question number 130 and 29 in a reverse method to calculate the answers for 131. Okay, sir. This is, with this question we have done with the security valuation question, a security valuation chapter, and I'm not going to waste your time. In the next lecture, we are going to start with the portfolio management. I understand that we have spent a lot of time on the security valuation, but trust me, this was the beginning. That's why I went slow, but slowly I am going to pick up the speed. Also, this was the only chapter which had 131 questions, a lot of questions, even though some questions are small, but it takes time. And lots of small concepts were there, but it will not be the case in the portfolio management and rest of the chapters. The concepts will be there, but there will be 4 to 5 questions on a single concept, so we can cover it up in 1 or 2 questions, and rest of the questions will be given as homework. So please understand, the 100 hours of the classes is there. I don't know at this time, by the time of this recording, I don't know how much it will go, but we'll finish it as soon as possible. See you. Bye bye.